Welcome back. Well, the Nifty went to around 17,050 odd and we have bounced a little bit from there. Remember, that's the crucial mark that we're talking about. But what is heartening today is the breadth of the market is better. So you have the mid-cap index that's down, that's more or less flattish actually, while the Nifty is down 0.5% odd. Portfolios will be feeling far better today. Well, time for an exclusive conversation. Then Eicher Motors, well, they had reported very strong sales in the month of February, and it was the third consecutive month when the company's CV sales are clocking that 7,000 units mark. Mr. Vinod Agarwal, the MD and CEO of Volvo Eicher Commercial Vehicles at Eicher Motors, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, Tata Motors, they have gone ahead and they've announced a price hike of closer to around 5% on their CV portfolio. For you, you have been talking about bringing down the discounts. So give us an updated number. What were the discounts you were giving, say, 6 to around a year ago, 6 months to around a year ago? And currently, what have they come down to?
Fundamentally, there are no fixed rates of discounts. They are as per the market conditions. And these discounts are decided by the market leaders. So therefore, I will not be able to give you exact figure that how much was the discount and how much is the discount now. But at the same time, there has been, I think, good awareness all across. Everyone wants to reduce the discounts because current discount levels are not sustainable. Therefore, there has been movements towards reduction in discounts.
Okay, so directionally then discounts are coming down, which is good news for you. Absolutely. What about you have been clocking closer around 7,000 units per month? I think I'll just ask my team to pull that number up. Do you believe that this is sustainable? Do you see an improvement from year on a monthly basis?
Yes, I think the industry is going as per our expectations. And if you look at the figures for previous months, previous years, we are still down from the earlier peak of 18-19. So industry is still away. Even after taking this growth, the industry is still down as compared to the earlier figures of 18-19. At the same time, since we have improved our market shares, we are better than our earlier peak of 18-19. So whereas industry is down by around 18% as compared to earlier peak of 18-19, we are up by around 5 to 7%. So relatively we are doing better, but industry still there is more growth potential to come in the next year because still we have to reach the earlier peak first. And I am very optimistic that industry is going to hit a new peak in next 1 to 2 years.
Okay.
So that's
although
period of industry.
Okay, all right, and that's important, right? I mean, the industry is to grow for companies to do well. Mr. Agarwal, good morning. And you're optimistic of that. So this 7,000 sort of run rate, will this go to 7,500, 8,000? Or will it be a very gradual process? I mean, just give us some sense.
March is going to be a better month, I would say still, because March is, even if you look at the last March 2022 figures, 22 also was very strong. And this year, it is likely to be even stronger. Even though the growth from March to March will not be much, because last year March itself was very high, and because of that base impact, the growth with respect to last year March will not be that much, but with respect to February, the growth will be very good. So therefore, we are expecting even better in the month of March than our earlier months.
Mr. Agarwal, good morning. Just to go back on the price hike issue, I mean, I guess for Tata Motors, it was largely because of the new norms, the BS6, I think phase 2 norms that come into play from the 1st of April. Would you have to look at price hikes in any part of your portfolio? I don't know if the norms impact you as well. And if yes, to what extent?
Definitely, the norms impact the entire industry. And for us also, there is a cost increase. But as I mentioned earlier in your show, that the cost increase this time is not like earlier BS4 to BS6. The cost increases are less. Therefore, we are also expecting the price hike of around 2 to 5%. And then, of course, there is also some inflation impact because April, every year the price increase happens. It's not that in April, so it's a normal price increase plus the impact of BS2 step 2.
So 2 to 5%. You're saying 2 to 5% because of these because of these factors. So pretty much in sync with what Tata Motors did. So, to go back to the questions my colleagues were asking, Given the high cost of ownership, interest rates are high, the environment is a little more cautious, and there's a price hike of 5% coming in, do you see this impacting demand to some extent?
I don't think so, because the economy is doing well. The truck industry is linked to the economy. If the GDP growth is there, like this year we are expecting GDP growth of around 7%. And next year also we are expecting GDP growth. And there are infrastructure investments happening. If there is a real growth happening and the infrastructure investments happening, then you need more and more trucks to do the jobs. You have to move more goods. You have to do more construction activities. So then you need more trucks. And of course, there are lot more pent-up replacements required, because replacements were very less during the COVID period. So therefore, the industry still has to grow more, and it is still away from the earlier peak. Therefore, I don't think demand will be less. It is going to grow next year as well.
Good to know that demand is strong, sir. I just wanted to clarify one point. You said that March will be better than what we have seen in the previous couple of months. Though on a year-on-year basis, it could be a little lower. I think last March you did around 8,800 units. So how much lower will it be in comparison to that? 5% lower, 10% lower?
Still, the March is going on. I can't say how much it will be.
Or will it be 8? Or will it be? Or will it be 8,000? So not better, but much better than February.
We are trying to do more. As far as we are concerned, we are trying our best to do more than last year March.
So it will be better on a month-on-month basis, but it could be a little bit lower on a year-on-year basis, right?
I can't say how much it will be exactly, because you will know only at the end of March.
Okay. All right, Mr. Agarwal. Thanks so much, sir, for stopping by and filling us in with those views on the space. But let's move on then, and let's talk about a couple of other spaces that have been grabbing our attention. We just spoke about the oil and gas space, and we'll get to that in just a bit. But someone who can discuss both those two themes. One is oil and gas, and the other one is cement as well as metals. We have Pinakin Parekh, Executive Director in Metals and Mining, Oil and Gas and Cement at JP Morgan India, who joins us on the show. Hi, Pinakin. Good morning. Thanks so much for joining in. Well, let's talk about the cement space before we get to the oil and gas space. You know, demand has been very, very strong. The disappointment has come on the pricing front. And this is a seasonally strong quarter, but yet we haven't seen price increases. So keeping that in mind, what kind of an EBITDA improvement are you working with for the industry for quarter 4? And given that input costs have cooled down further, for an industry, what kind of improvement can we see in the first quarter of next fiscal?
Sure. Good morning, Nigel. So for the cement stocks, obviously this has been an unusual quarter. When you have demand growth like this, you normally have price hikes. It has not happened this time, and we attribute this mainly to the slew of new capacities that are getting ramped up across the industry. Industry is seeing a capacity expansion cycle after many years, and the new supply is putting a lid on cement prices. Most of the companies in their analyst calls had indicated a cost decline of roughly 150 to 200 rupees a ton, and that should broadly flow through to the bottom line in Q4 at this point of time. Q4 seasonally is also higher volumes, so to that extent there will be operating leverage. The question obviously is that from here, do we see further large cost declines, which will essentially be a function of petcoke prices? Petcoke prices have cooled off, but again, they remain stubbornly high above $160 a ton. So we need to wait and see whether there's a next round of energy price decline across the board or prices stabilize here at this point.
Okay, all right. But for this quarter, you're seeing around 150 rupees odd improvement is what we should be factoring in for quarter 4.
That is what the companies have broadly indicated in their analyst calls. So at this point, that is what the cost decline looks like.
Okay, all right. The other factor that the street is looking at with regard to cement is that the Adani Group, both the cement assets, they got into a bit of a sticky spot. And then the hope was maybe they won't be very, very aggressive. How are you reading this? Now it appears the group is back on track. If they're back on track and they're not so leveraged at a group level, then they could pick up their expansion plans. That'll be a little bit negative for the industry because pricing power is not there. And then you have the problem of additional supply.
So we would refrain from making comments on individual companies or business houses. But
no,
what
for the
we would
industry,
highlight is that the sector is basically... Sure. So for the industry, what we are seeing is one of its kind of capacity expansion cycle. If you do a bottoms up, across the listed and unlisted cement space, there is nearly 100 million tons of capacity addition on its way over the next 2 to 3 years. The industry more or less has decent profitability at this point. Balance sheets are mostly under-leveraged on net cash balance sheets. So overall, we see a multi-year capacity addition cycle ahead across players. And I don't think it's about 1 or 2 players. So we need to see strong demand continue on a multi-year basis for profitability hold up, because capacity addition is only going to increase, not decrease from here.
By the way, before, Pinakin, hi, good morning. Before anything else, let me just quickly highlight that we've had our first recovery of the day before it completely disappears. Let me just put that on the table. The Nifty will tell you that. We got to almost a flat terrain. I mean, 17,130 or so is what the market got to. And now, of course, we are coming off again. So from being down 90, we were down just 20. There was a 70-point pullback, as I said, the first of the day. And that's getting a little bit pressured at this point in time. Surabhi.
Well, Pinakin, before we move on to the oil and gas space, just wanted to focus on the cement space yet again. Geographically, what's looking good? At one point in time, we had North India that was doing very, very well. And I'm looking at your top buy, I think it's on Dalmia, which has exposure to the Northeast and some part of South as well. Geographically, any particular space is looking better than the others?
So let me put it this way. I think what is happening this time is that you have cement demand which is broadly, stable or similar across regions. And this time the capacity addition is also similar across regions. So I think we are not in a period where regional preferences would be, the key determinant for stock selection. You have a pan-India cement addition cycle. So I think we have to wait and see how prices hold up across regions rather than see whether prices would be better off in A region versus B region.
Pinakin, hi, good morning. Surabhi here. If I could just move to the oil and gas side, because, that sector has become so newsy, so many headlines, right? We were just chatting with the managements of IGL and Mahanagar Gas, and the conversation was on, of course, one, this tariff hike that GAIL has seen come through. But the other bigger change for the sector, the implementation of the Kirth Parikh Committee recommendations on gas. Specifically on gas, how do you see the next couple of months play out, given that we're in the midst of a lot of these regulatory changes and a dramatic fall in LNG prices?
So in gas, there are 2 events. One is obviously the committee report. We don't know as and when what the committee report will finally be implemented and when will it be implemented. But in the near term, what has essentially happened is spot LNG has gone from $50+ MMBTU to $12, $13 MMBTU. So you have a sudden increase in LNG imports. Gas cost across the gas consuming industries will lower. We are in the shoulder months, essentially in the global LNG markets, transitioning from winter into summer. So gas prices normally are seasonally lower at this point of time. So if you are a gas consumer for the next few months, you would see costs reduce materially. India's gas demand is price sensitive, and a lot of demand consuming sectors were negatively impacted last year. We saw imports fall very sharply. This will reverse over the coming months. So I think the gas value chain should benefit from lower spot LNG prices, at least for the next few months. But again, this is difficult to extrapolate through the year. We still don't know how Europe's LNG imports will position itself in the second half of the year, whether you have a warmer winter like last year. So we expect LNG prices to be volatile. Right now, they are at the lower end of the range.
Pinakin, you guys put out a report on Reliance recently, highlighting that it's at a very attractive level now. Just talk us through sort of the main highlights, why you believe so.
Unfortunately, Prashant, we cannot comment on single stocks and company-specific events. Okay.
But fair enough. I mean, the stock has done well since that note actually came out, some 5-6% or so in that time period. Today, it's down about 0.75%.
Yeah, that was a big view. Of course, JP Morgan is quite bullish on the stock. So are a couple of others. I mean, we had reports from a lot of other major international brokerages as well, talking about a positive outlook on Reliance. But that apart, again, going back to oil and gas, Minakan, I think you folks are also constructive on OMCs. And that's because I guess they're reaping the benefits of lower oil prices on their marketing margin side. But what's the outlook on refining per se because of how volatile oil prices have been?
So refining at this point of time, let's break down the product outlook. So this is the year for China's, airline sector. Jet fuel demand should increase very sharply as Chinese go back to traveling. In fact, a large part of JP Morgan's 1.7 million barrel oil demand increase essentially comes from China. So to that extent, the refining outlook is steady. Again, benchmarking it to last year would be wrong because last year was one of its own, events. We are not going to see diesel cracks go back to $60, $70 back again. What we need to wait and see is also how the Russian products are getting placed in the market. So far, there does not seem to be any big dislocation in the product market. So we have improving product demand in China. We still have tight supply on the product side. So refining margins should be steady, but again, are unlikely to, to see a repeat of last year.
All right. Pinakin, final question then before we let you go. Just can't let you go without asking you about metals. So what's the preference out there? Ferrous or non-ferrous? And from the ferrous pack, what's the preference within that? Integrated or non-integrated?
So to that extent, okay, so on metals, what we have is, a difference in terms of what is on the ground China demand, which is very strong, and the sentiment risk of in the US and Europe. Chinese demand tends to be positive for ferrous. We have seen iron ore prices remain strong, steel prices move higher. So between ferrous and non-ferrous, we believe ferrous has a better demand outlook, and we would prefer the integrated ferrous companies in India.
All right, integrated ferrous companies in India, a better bet at this point in time. Thanks very much, Pinakin. It's always a pleasure. Appreciate you joining in with your perspective on a variety of issues, oil and gas, cement, and a little bit as far as steel, the metal space is concerned. So that's Resources, a comprehensive chat from one of the top analysts in the space. Okay, I think we're just waiting by for the GAIL management to join us, and we should have that up in just a bit. Of course, the news came through for GAIL. We already spoke with consumers like IGL and MGL. Now, of course, we get to speak with GAIL and ask them what this tariff hike would actually mean, the integrated tariff would mean. So the stocks are actually down about 1%. It's not very much by way of a reaction. 104.4 is where the stock is right now. Let me just take a quick look at the market, which is actually coming up. We're down 30 points, which means we're about 60 off the day's low. And that's a good thing. 1,200 stocks are higher, and you've got about 800 stocks which are lower. So overall, it's a good-looking picture at this point in time. I think we do have the management of GAIL now joining us. Rakesh Kumar Jain is Director of Finance at Gas Authority, and he's with us. Thank you very much for joining us, Mr. Jain. Good morning. Prashant this side. My first question is... My first question, congratulations, first of all. This has been long in the coming. It's come, but the rate has come in a little lower than what you had kind of put in as, or what you really wanted. So my first question is, will you appeal against the assumptions of lower gas prices which are implicit in this rate?
Yeah, thank you very much. Let us first thanks PNGRB for making a big reform in terms of tariff. This is a welcome step in terms of the development of market, because it will change the current regime of tariff, which is actually pancaking tariff or cascading tariff. It means that if a consumer uses the more than one pipeline, he is required to pay the tariff for the pipeline he uses. And actually it is prohibitive if you talk for development of gas-based economy in far-flung areas. To that extent, it's a reformative step, and it will enable the increase of share of gas in energy basket. Coming back to your observations, yes, we have seen the order. Of course, we are examining, and prima facie there has been reduction of around 10 rupees per MMBTU, and major reduction PNGRB has done of ₹5.76 on account of fuel gas consumption for our internal consumption in compressor stations. PNGRB has considered a gas price of $3.61 per MMBTU for APM gas and $6.98 per MMBTU for HTHP gas. And you can vouch for yourself. It's a significantly lower even if we compare with the current prices and even if we consider with the likely prices based on the Kirtpari committee report. And certainly there are some more factors like capacity. PNGRB has considered a capacity of 175 as against capacity submission by 168, and most of the reductions PNGRB had done on assumption part. Certainly we are examining the order and we will go back to PNGRB for review of their tariff order which they issued yesterday. So it's a very early reaction because we have received yesterday only, and these early study suggests that certainly we will approach to PNGRB for review of tariff for upward revision.
So, Mr. Jain, you are happy, but you're also slightly unhappy, and you're saying that you will prima facie. This is, as you yourself said, very early reaction, but you will appeal for a relook, right? Because
certainly,
this is 10 rupees lower than what you'd asked for.
But Mr. Jain, if I could just understand, while you appeal this and then we need to see what is the view that the board takes, some of the estimates on the street are suggesting that going by this hike, 45% itself, your EBITDA could move higher by maybe more than 2,000 odd crores. Could you give us some ballpark estimates of right now with this hike, what is the improvement at the EBITDA level that you would expect?
Let me first tell you that the PNGRB has notified the tariff for 9 of our physically interconnected pipeline. If you see the weighted average tariff for those pipelines currently is around 46 rupees per MMBTU, which has been increased to 58 rupees 61 paisa. That means there is an increase of 26% for these pipelines, and this increase will result into increase of our revenue and also the EBITDA by almost 1,600 crore rupees per annum, only based on the actual volume flow being done by us.
Okay, so when you talk about the actual volume flow in Q3, it was 107 MMSCMD. Now that we are seeing that globally macros are also changing, we are seeing higher imports as well in terms of spot LNG. What will it be once volumes increase? First, what is your volume guidance for FY24? It should be higher than FY23, going by what I said. And what will then your EBITDA look like once these tariffs also kick in from 1st April?
Yeah. We transmitted around 111 million gas per day in last financial year. So this average volume has come down by 4 MMSCMD, and for next year we expect to transmit around 122 to 123 MMSCMD, and that will increase our EBITDA by another 1,000 crore. When I'm talking based on the revised tariff, based on the existing volume, our revenues will be 8,100 crore, which will further increase by around 1,000 to 1,500 crore based on the increased volume. So that means our transmission revenue will increase from current level of 6,500 crore rupees to 9,000 to 9,500 crore.
Okay. In this, Mr. Jain, just wanted to understand, because last year was also impacted by lower supplies coming in from Gazprom. So you, of course, had to buy higher priced gas, right? And also you will see additional volumes from new fertilizer plants that are opening up as well. Can you tell us what is the additional demand or additional volumes that you're seeing from this 107? How much will it be from these additional cargoes that will come in from Gazprom?
Let me give you a little detail about it. As you know that we are transmitting around 107 MMSCMD of volume, and in view of disruption in Gazprom supplies, our volume also went down. And some of the customers, though, transmitted pipeline through our purchase the volume from others and transmitted through our pipeline. Even if we consider that 3 to 4 million per day consumer switched over to alternate fuel because of the higher gas prices. So those volume is likely to come back. Secondly, we also ramped down our Pata plant, and we expect to consume 3 MMSCMD of gas on an average basis, additional gas in Pata plant. And as you know that CGD is growing on double-digit growth basis, so almost 3 million additional volume come from CGD. And then 2 of the fertilizer plants, which are almost stabilized, Baroni and Sindri, will take almost 4 MMSCMD of gas. And apart from this, along Jagdishpur Haldia pipeline, we expect some more volumes to come from refineries. So this will take us to around 122, 123 MMSCMD per day.
Okay, interesting. So that is about the transmission bit. And let me just quickly talk about the marketing segment as well, because that's a very volatile segment for you, right? EBITDA can be very high one year and very low the other year. And that's something that is worrying the street, that yes, while transmission will do well, marketing continues to be very volatile. What is your take now that spot LNG prices globally have been coming down? Usually higher spot LNG prices are good for GAIL, but that has not been the case in the last 2 years. What is your take here?
No. Last in financial year 22, we earned around 5,000 crore from marketing segment only. And this year, in spite of being volatile market and disruption in supply by Gazprom, still we earned almost 2,500 crore plus in 9 months. So what we based on our computation, we are likely to earn around 3,500 crore rupees from gas marketing in financial year 23-24.
Okay, so Mr. Jain, then that's how we are looking at both your segments, transmission and marketing. Just to go back to the headline, you are going to be appealing this, and also leave us with some thoughts. I mean, 1st April, the entire regime will change come the implementation of the Kirit Parikh recommendations. FY24, what's the outlook? If you could give us some headline figures on the top line and the EBITDA, given this massive tariff increase as well.
Let me give segment by segment. I have already explained transmission and marketing segment. Once Kirit Parikh committee report is applicable, approved by government, it will also have positive impact on LPG. Currently, we are booking LPG internal consumption at $8.57 per MMBTU. If based on the report which are coming, that if gas price is approved at $6.5 per MMBTU, so it means there will be reduction of almost $2 per MMBTU for internal consumption in our LPG plant, which means that we will additionally earn around 1,100 crore rupees per annum in LPG business. And the petrochemical segment is also now we see some positives in it, because we have seen worse, because we ramped down the Pata plant because of the higher gas prices, and now prices has cooled off. In fact, the polymer prices has also gone up. So we also see there will be some positive in that segment, which has actually gone red in last 9 months. So considering all these factors, we expect that this coming year will be quite good year for us.
All right, Mr. Jain, thank you very much. Good speaking with you, sir. And we'll touch base soon again. But lots of numbers, lots of clarification. And of course, I mean, you're saying that you will go back to PNGRB and appeal the order, the tariff which has come through for you. By the way, the market is, it's a solid green candle now. And the market is now very close to breaking into the green. Just 15 points lower after an early 90-point cut that we had at the Nifty. Up next, Mitesh will join in with some technical trading ideas. We have to take that break and come right back with Mitesh on the other side. Okay, welcome back. 10 points. Slowly, the market is coming back into the green, and why not? It did look, the sell-off was a bit unhinged last night after that single comment from Treasury Secretary Yellen. And I mean, if a headline is all it takes for the market to sell off like that, then I'm assuming a headline is all it'll take for the markets to do well, which can happen, I mean, anytime through the course of the day, because all eyes will be on what, the regulators say next with regards to bank deposits. 17,134 on the Nifty. This is looking good. Mitesh is with us. Mitesh, would you be a believer that the market perhaps is past its low point of the day? Or there could be another leg coming? What's your sense?
Prashant, I would possibly, favor the fact that the markets could have made the intraday low today or low for the day, and good chance that we'll possibly attempt 17,175, which was yesterday's high or just near yesterday's high. again and then head towards 17 to 5300. See, the hourly and the 2 hourly charts clearly have a positive structure. Now, with the news flow, I think there's some volatility and we are seeing bouts of selling, but this is not strong selling as we saw a couple of days back when the markets were continuously making newer lows. So, yes, choppiness is there. Markets aren't out of the woods as yet. I think you will see this kind of intraday volatility happen. But broadly, I think this is a market which over the next 2-3 days could possibly inch higher. That the odds are much more stacked towards that side. So I think we are trading with long bias. In fact, I talked about 17,050, 60 as the support area. We got a low for around 17,045. So that level is holding out. Good chance that if we start getting past 17,175, then I think we are looking at another 100, 120 point kind of a continuation on the upside. Having said that, I have one buy and one sell call on the stock side. Info Edge or Naukri, I think that's on the buy side. Here, recommend a stop below 3,500 for a target of around 3,610. And BPL is something which might be on the verge of recording a breakdown. So have a negative or a sell call here. Keep a stop just around levels of 92.70 and look for targets of around 88 to about 87.5 on the downside.
Okay, all right, Mitesh, we will leave it there for now. Thanks very much, and we'll touch base with you during the course of the day. Let's see how it goes right now. Very flat trends on the market. We need to take a break on that note, but on the other side, Lata comes in, and today she will be speaking with Peter Cardillo of Spartan Capital Securities, as well as Jeffrey Dennis.
Well, the Fed has brought some finality to the rate cycle. One and done is what they said, more or less. But the market, after rising, fell, probably reacting to Janet Yellen's statement that the government is not looking at an insurance of all deposits. Well, US yields and the dollar have fallen, but so have several equity markets as well. In fact, most equity markets. To parse the Fed's moves, I have with me two experts, undoubted experts, Peter Cardillo, the chief market economist at Spartan Capital Securities, and Jeffrey Dennis, the emerging markets commentator, a long-standing emerging markets commentator. Gentlemen, I'm deeply grateful that you all have stayed up for us this late in the day for you. Peter, to you first, what should the markets take away from the one more hike only statement? One would have thought there was cause for a rally.
Well, I think the market is happy about that, but I think what happened was that, Treasury Secretary Yellen basically said that it's not a blank check for depositors of all banks. And that was somewhat alluded also by Fed Chief Powell. And as a result of that, the market came in.
Would you think the market worried when Powell said that financial conditions themselves are tightening and that will propel the slowdown of the economy? Did that worry the market?
Yes, they said that they're going to be data dependent, and basically they hinted to the fact that a terminal rate is not that far away. That is the end of the tightening cycle, and of course, I think the biggest factor here is that Mr. Powell also alluded to the fact that the economy is weakening, and it's hard to tell whether or not we're going to recession, despite the fact that he said that a soft landing is still possible.
Oh, yeah. I'll come back to you on the recession question. Let me invite Jeffrey Dennis as well. Jeffrey, pleasure having you with you once again after quite some time. Now, do you think the Fed has cracked the dilemma? Reassured markets on inflation and on financial stability?
No, I'm not sure they have today, frankly. I think, obviously, what they're trying to do is to reassure markets that they are going to get on top of inflation, which, by the way, is falling anyway. And I think in that respect, they've probably dealt quite well with worries over inflation and ensuring it goes down. But I think to be raising interest rates today, even by 25 basis points only, at a time when the banking system is under pressure, and with the other hand, if you like, they're trying to support the system with increased liquidity, the swap arrangements that have been intensified, etc. And with all the pressure there is on the banking system, I think it was a slightly strange decision they made today. It is, however, hard in one policy meeting to do both the things that you mentioned, to reassure the system, the market about the stability of the banking system, at the same time reassure everybody. I would like to have seen a bit more effort to reassure everyone about the stability of the banking system.
So, Jeff, you don't think the market was more rattled by Yellen's statement that they are not thinking of blanket deposit insurance like Peter referred to?
No, I mean, that may well be the case. I don't know how preordained that comment was from Janet Yellen. That clearly played a role in the sell-off that we had later in the day. And it's a surprise because I think there was this sense developing that the FDIC would begin to backstop all deposits down the road. But at the end of the day, you still have a dilemma here between stabilizing the banking system and continuing to push interest rates up on the idea that will continue to bring inflation down. The banking system crisis we've had in the last 10 days, 2 weeks, has tightened monetary conditions significantly. I think at the margin it has increased the risk of recession in the next, shall we say, 3 to 9 months. And therefore, with inflation falling anyway, with wage inflation reasonably under control, I don't think the Fed needed to raise rates today. What they could have done today is hold the rate. We're supporting the banking system, but if the inflation story continues to, if the inflation story deteriorates again, we will have no hesitation about going back to raising interest rates again. It's hard to marry those together at the same time.
Okay. Okay, now let me toss that to Peter. Peter, do you agree? Do you also see a recession in the US before the year is out?
Yes, I think we're headed for recession. I think if they raise one more time, we'll probably have a mild recession. But if they opt to raise, let's say, by another 50 basis points, then I think the recession could be more severe.
Okay. All right, let me come to inflation then, Peter. Do you think a terminal rate of 5 to 5.25 will be enough to bring inflation to the Fed's target of 2% at some point in time?
I think that all the rates have not yet penetrated the economy. And so we're looking at maybe 75 basis points that need to infiltrate the economy. And once that happens, I think inflation will come down rather rapidly. Now, we saw over the past 2 months inflation move higher. And I think that was more due to seasonal factors as opposed to any real structural hike in inflation. So, yes, I do believe that inflation will come down. Do I think inflation will retreat to the Fed's desired level of 2%? No, that's not going to happen for many years.
Then perhaps rates are going to be elevated for long. Okay, that apart, Peter, what are the chances of a trading rally or a tactical rally in equities now? Because there is a bit of certainty on the terminal rate.
Well, I think, we'll see a rally. I think for the moment, we're probably just going to stay within a trading range within the S&P 500. And that range probably be somewhere between 38.50 and 41.50.
Okay. All right. Hold on, Peter. Let me get Jeff into this now. Jeff, let me come to my audience. What is in it for emerging markets? Are you expecting headwinds in terms of global growth?
I think what today's action has done is made the outlook for emerging markets a little bit more uncertain in the very short term. let me just say this. I think the market action today, bonds up, equities down, and dollar are down as well, which is a little bit odd. It wasn't a classic flight to quality, which would have meant the bonds were higher and the dollar was higher. Is telling you, I think the markets themselves do worry a little bit more about recession than they did 48 hours ago. Now, obviously, as you and I have discussed before, a weaker dollar is very good for emerging markets because it sucks money out towards higher interest rate economies, more risk, if you like. And so that is helpful at the margin. But I've been very bullish about EM equities this year, and I still am bullish. But I think this whole series of events here in the last 10 to 14 days, and the Fed's response today makes us a little bit more of an uncertainty in the short term. But I'm still tending to recommend to people to buy the dip here because I think the dollar is going to go lower. But I think everything's been made a little bit more complex and uncertain in the short term by the events of today.
Oh, yes, that they have. But you said you will buy the dip in emerging markets. Where does India figure in your list of EMs, especially vis-a-vis China? I mean, do you see Indian equities as second to China? And basically, how do you see Indian equities perform this year, per se, in absolute terms?
Yeah, I mean, I would certainly rank it no lower than second. I mean, I don't tend to do a ranking as such. I just tend to list the markets I like. But given that India, the year-to-date in dollars is down 8%, and the asset class as a whole is pretty much flat. China's pretty much flat. I think there's every reason to believe India could well outperform China from here. Taking the year as a whole, maybe China continues to be an outperform because it's 800 basis points ahead right now. But if I were putting money to work right now at this point in time in India versus China today, I'd probably tend to favor India over China. I really like the growth story in India still. I know there's concerns about earnings. There always is, always concerns about valuations, but it is a tremendous amount of interest from foreign investors long term over the fact that India is going to have a higher population than China right now, very soon. It's got tremendous growth potential. It's going to have a much higher growth rate, I think, this year. Let's say a higher growth rate, not much higher than China. And I think, as I say, the RBI has done a really good job in terms of monetary policy. So I think India does look good from here. And from here on to the end of the year, I think there's a good chance India will outperform China.
Okay, a lot of people absolutely agree about the monetary policy bit that you're talking. Peter, to come back to you, what are your thoughts on emerging markets like India? I mean, generally markets in Asia like India.
Well, India has done pretty good. It's basically outperformed, but with the rest of the central banks raising interest rates, it's hard to think that India is going to escape some sort of a slowdown. And I believe that we're probably headed for a global recession.
Oh, yes, there is that. Okay, then finally, what's your order of preference amongst asset classes, Peter?
Right now, I would say 60 bonds and 40 stocks.
Thank you very much, Peter and Jeff, for staying up for us and parsing the Fed action. Out of time entirely on Bazaar. Chartbusters after a very short break.